Okay, let's look at this kind of problem. This is one where, as we discussed in class, T accounts can really help you solve a problem like this because basically it's asking you to fill out what is unknown about a certain account, and understanding the dynamics of how T accounts work will really help you. So here we have a T account. You're being asked to solve for the unknown amount of cash paid in December. You're needing to compute a couple of things here: the cash paid during December, the cash collections for customers during December, and the cash paid on notes payable during December. So you're doing some analysis. With analyses, I can tell you that T accounts really help. So let's look and see. It's less important that you just kind of magically have these numbers. It's more important that you understand why these entries are in the right sign that they're in. So let's look first. Let's do the easy stuff first. Right off the bat, when you pull in the additional data, you notice that if up front it's telling you, right? It's telling you that the beginning balance in the cash account is $10,500. So at this point, you need to ask yourself, what kind of account is cash? Is it assets, liabilities, or stockholders' equity? Well, it's obviously an asset account. Asset accounts have a natural debit balance, left side of the T account. So it's automatically, right off the bat, you know that cash at the beginning of this cycle, this monthly cycle, was 10,500. And that's why we have this here, because cash at the beginning of the month, prior to beginning December, was 10,500. Then it also tells you right here that 5,250 is what it was at the end of the month. So it's, again, cash is an asset, normal debit balance, the left-hand side. We put it as an ending balance for December 31st. Then it tells you, by the way, during the month, you had cash receipts of 93,000. This is when it's helpful to understand how cash receipts are booked. So let's go over to the whiteboard and look at it. Okay, let's look at the problem said that beginning cash was 10.5. Okay, so we know that's how we started. And then we ended up with 5,250. 10.5 is 10,500, just shorthanding it. And then it says that cash receipts was 93,000. I'm reacting to this right here where it says cash receipts 93,000. When we receive cash, cash goes up. Cash is an asset, so it's going to go up on the left-hand side. 93,000. So really, when you come over here and it asks you, prepare the T account to solve for the unknown amount of cash paid. Well, anytime cash is paid, right, if the left side makes cash go up, that's the ending balance, that's not an entry. If the left-hand side makes the cash go up, then the right-hand side has to make it go down. So then it's just a matter of solving for what this is, right? So if you take 10.5 and and add 93,000, and then subtract from that 10,500 plus 93,000 even, and subtract 5,250, you get the 98,250. So let's put the 98,250 here. You'll notice this is a classic where we give you 3 and you solve for the 4th. So you were given this right here. You were given the 5,250. You were told that 93,000 was collected. Now the problem is which side does it go on? You just have to know that cash, when it's received, makes cash go up, and then the difference is the 98,250. Let's move on. In this example, instead of analyzing cash like we did up here, we're going to analyze accounts receivable. Remember, accounts receivable is what we hope to collect in the next 30 days. Again, the problem, when you click here, it pretty much gives you two of the four components, because immediately it says, by the way, beginning balance of accounts receivable was $27,000. Accounts receivable is money coming towards our company. It's an asset. Assets have a normal debit balance, so you just stick 27,000 here. It tells you the ending balance is 25,000. Notice there wasn't a huge change. So basically the whole problem comes to deciding where sales on account go. Okay? Remember that sales on account means that you had some sales, and let's say in this case you had how much? Sales on account of 45,000. Excuse me. You had sales on account of 45,000. So if you have your sales account here, you know that you sold on account 45,000. A question you ask yourself here is the money coming towards the company or going away from the company? If it's coming towards the company because we sold something, then it's an accounts receivable. If money's going away from the company, it's accounts payable. So we sold 45,000, and 45,000 when it's sold, you will notice, goes here. If we're going to record revenue on account here, what's the debit? Well, the debit has to be accounts receivable. We're going to receive in the future 45,000. So we'll put 45,000 here. Here's the debit, the asset going up. There's sales revenue, which is eventually closed to stockholders' equity. Stockholders' equity goes up with a credit. That's why we're on the right-hand side. You will also notice that that's for sales on account. That's what explicitly it says, sales on account. Money coming towards the company, sales on accounts receivable. There's accounts receivable. There's there's the sales revenue. There's accounts receivable. Notice it's not cash. We're not collecting cash for this. We're receiving a promise to pay in the next 30 days. So then, basically, what you're solving for is what's missing. What's missing here is the unknown amount of cash collections from customers. Keep in mind that when cash does come in, so we'll just put a little quick cash account here, right? When cash comes in on an accounts receivable, because it says we're analyzing the accounts receivable account, when the cash actually comes in from customers, then cash will go up by, in this case, well, we're going to back into it. We've got to solve, there are three pieces for accounts receivable. There's one, there's two, and there's three. So we just solve for the difference. Sum these two, subtract this, and you get the 47,000, which you put right here. The reason I have cash over here is to understand that when we collect, right, collect cash from customers during December, and this is accounts receivable, it would go here. The offsetting debit of cash going up would be right here. I'm not putting it up here because I don't want to, mess with that. There's only one cash account, but I just want to show you here that these are related to each other, cash and accounts receivable, because when we collect cash and that asset goes up, then this asset correspondingly goes down. But that's how you work this. You basically back into, you've got three pieces that you're given. You're going to have to decide what effect does sales on account have on accounts receivable. And sales on account, like that's the reason we have our T accounts. We sales on account, we have credit sales, and we debit accounts receivable, and then you just solve for the missing piece. Let's move on. Okay, the last one is super easy. It's basically notes payable. Again, you'll notice that an enormous amount is given to you. What you have to figure out is that cash is an asset and has a normal debit balance. All assets have normal left-hand side debit balances. They normally end up, excuse me, I've got this wrong, normally end up with debit balances at the end. And notes payable is not. All the payables are liabilities, and liabilities have normal credit balances. So again, just drop it in there. You start with 9,000. There's the 9,000. You end up with 17. You drop to 17. So now you have two of your four components. And then it's saying, by the way, you had $32,000 in new borrowing. Well, new borrowing means you owe more because you're borrowing more money. How does a note payable, which is a liability, go up? Well, it goes up with a credit, and you have new borrowing, so more yet even, and there you have it on the right-hand side. At that point, you have 3 of your 4 components. It's very simple. Add this to this, subtract the ending balance, and you come up with the December note payments. Basically, when it says solve for the unknown amount of cash paid on notes payable, this is how much was paid down. So you can deduce from this entry that what happened. Let me go ahead and erase it out. And let's just stick notes payable right here, just for purposes of discussion. Notes payable. You can deduce that what happened with this 24,000, we were given the 32,000, is that the amount of cash paid, you come over here, when cash is paid, it goes down, and we paid 24,000. And the question is, what did we pay it on? We paid it on notes payable. So there's the credit of cash hurting us, but notes payable, which is a liability, is likewise going down. And this, I'm showing both sides here, notes payable and cash. That's what this is right here. We started with this much debt. We ended with this much debt. It's telling us we borrowed yet even more. So here's a credit to increasing the liability. The difference is how much was paid down. The only way that notes payable, the only way any liability is going down at this point in the course is if cash is received to lower that liability. So anyway, that's how you work this kind of problem. Get good at T accounts. T accounts are your friend. And just think through, is it a asset? Is it a liability? Is it an owner's equity account? And like I said, it just gives you the beginning and closing balance. And then the only real trick is what effect does cash receipts have? What effect does sales on account have? And new borrowings. Hope you found this useful.